What's up, guys? Welcome to another video. So this video will be covering the Heat Academy investment strategy. I will try to go through this concisely and fast because I know everybody does not have a long attention span. So I've shortened down the points to the main bullet points. As you can see, there are 13 points. These are not the trading steps in particular, but it's important. These are important points which you must know if you're going to go ahead and take on our strategy. First, invest what you're willing to lose. I think this is very important, and it applies to not only our Heat Academy investment strategy, but it applies to anybody who wants to make an investment in any sector, whether it be crypto stocks, forex, real estate, anything, gold coins. There's a long list, horses, whatever you want. Always risk what you're willing to lose, because there is no 100% guarantee that an investment will work. So you only want to be investing what you're willing to lose in the case that everything goes to zero, that you aren't left homeless. Number two, due diligence on your coin must come first. Due diligence is essentially when you are doing the research on your coin. This is the fundamental research where you're looking into people who own the coin, their history, the project of the coin, the main function which it serves to crypto, its competitive advantage with respect to other crypto coins and other projects. You need to do your due diligence first before you start looking at technical analysis, because the technical analysis could be fine. However, you could be investing into a subpar coin, in other words, a shit coin that has very low utility. It's not functional, it's not scalable. If you haven't looked into this, then you could find yourself in a big problem when it goes to the future, comes to the future, when you're now investing. Your technical analysis all lines up, but had you just done a bit more research to find out that there is no utility or the function which that coin is serving to the crypto space has been done by 10 other companies at a larger, more scalable procedure, and there's not a lot of room for growth for that particular utility, in that case, your coin will struggle to perform regardless of the technicals aligning up. So you want to do your due diligence first before you get involved in any project. Number three, higher timeframes are king. You want to place lots of emphasis on your higher timeframes and macro analysis. And the reason why we choose to do so in this Heat Academy investment strategy is because it allows us to make fewer mistakes when reading price action. When you're reading day-to-day, hour-to-hour, minute-to-minute price action, there is a lot of information and data for you to digest. And this makes you more prone to making mistakes. Mistakes are human, but we want to minimize the mistakes we make so that, in essence, we increase our strike rate, increase our profit, and reduce the amount of losses we take. That is why we focus on the weekly, the monthly, and the quarterly price action. Yes, it takes longer for this price action to play out. However, the quality of trades that we will be taking will be much higher because there is less information for us to digest, which means there is less chance for us to make mistakes. Therefore, making this process and this strategy more profitable. This is why we say we really do recommend, especially if you're new, focus on the higher time frames and stick to them. Yes, it takes a bit longer, but you'll be more profitable by the end of the year. So which would you rather have? Take more trades and risk losing more, or take less trades and making more? I know which one I'd choose. So that is number three. Also, we are doing speculative trading. So it's important for you to know that, yes, we do consider ourselves investors, but we are still speculators at the end of the day. There's no guarantee. But you have a better chance of making a profit if you're taking less trades, especially in an environment where crypto on the day-to-day or the hour-to-hour can be very volatile. And you can easily find yourself missing moves, getting faked out, thinking that you're seeing a move when it's not. All these core problems. Number four, we take trades which typically range from a few weeks to a few months. Not much else to that. It's just again, because of the way we trade using the higher time frames, it takes a lot longer for our predictions to come out, for better or for worse. It just takes a lot longer because the patterns and the analysis form over a longer period of time, which therefore means it will take us a longer period of time to reach our set goals, because we set our goals, our take profit levels, based off the weekly and the monthly time frame. So again, it just takes time. Number 5, we do not leverage trade. We only perform spot buys. Again, a benefit of this strategy is that we don't have to use stop losses because we aren't leverage trading. I will get into stop losses and take profit levels later on, as you can see on the right side, but we do not leverage trade. We only spot buy. So yes, you aren't able to make ridiculous amounts of money if you are limited to lower capital, but you always have the option of getting more money from a job or other sources of income. This crypto investment strategy is a multiplier for the money you have. That's how you should think of it. So you just go source money from other streams, bring it to crypto, you multiply it. It's a simple strategy. Number 6, we typically take about 4 trades a year. It could be a bit more, a bit less. Range is around, I'd say, on average about 4 a year. Again, this is a very hands-off strategy. This is investment, because I'm more than aware that a lot of people who are looking to the strategy have other commitments in their life, responsibilities. They don't have the time to be day trading every day, waking up for London session, the New York session. Everyone has jobs, other commitments, which is completely fine. This is a strategy which allows you to stay passive in the market, but it gives you some exposure to the crypto markets and the profits that you can make. Number 7, so everything from 7 till 12 will be with regards to risk management tips. That's why I put it in blue. Number 7, all trades must have a good risk to reward. So the importance here is that, yes, we don't take a lot of trades, which means that you're going to feel that you're sidelined and you're not doing a lot for most of the year, which is the case. Warren Buffett even says the best traders do the least. So this is what we try to emulate when we do these investments, when we have this investment strategy. We're not trying to do a lot, so you may feel sidelined. Now, with regards to number 7, this will typically mean that if you have friends that invest or do any form of things with the financial markets, you will probably hear them taking a lot more trades than you and getting involved and telling you to get involved when they are getting involved. You must remember, the reason why we take so little trades is because we only want to be taking trades when the reward and the risk is highly in our favor. We try to take trades from the cheapest possible price, so that even if we take drawdown of 50% from that cheapest possible price, we know that we are still buying 80% from the highs, or 85 or 90% from the highs, which makes more sense to take 50% drawdown from a very, very low point than it is to take 80% drawdown when you're investing 15% away from the highs. Yes, you might make a bit of profit. You could make 20% on your profit you can make 20% on the money you've invested if you're investing at those highs. However, what you stand to lose is a significant portion of your money, and it will take a very, very long time for you to get that money back and hit break even, let alone make profit. So it's better for you to take that risk from a lower price point, where it will not only take a shorter amount of time for you to get your money back, but also for you to then go into profit and hit your take profit levels. It will be a lot quicker. That is why we say we like to take trades from very low prices, so that we have good risk to reward. All your trades must have good risk to reward, or it is not worth taking. No point taking a trade for, like I said, 15 to 20% profit when you could potentially risking 80% of your money. Number 8, do not hodl. Instead, DCA. So hodl means hold on for dear life. DCA means dollar cost average. Now, what are these two things? HODL is essentially was a word created by the retail investment market, especially online retail investment market, where you buy a coin and you hold on expecting $10,000 or 10,000x on the coin that you've bought at 3 cents, and you do not sell until it hits that $10,000, and you don't care about the drawdown, the risk, or blowing your account, that is HODL. They typically say we've got diamond hand, we will hold regardless of what price does. That is a terrible way to invest, and it will lead you to losing money. You will 100% lose if you become a hodler. I know guys who have made up to 3 million in floating profits and decided to, this was from a £20,000 investment, to make 3 million, keep holding because they were told on Twitter by a guru. I know how it sounds crazy. They were told on Twitter by a guru that the price was still going to go up, so they kept on holding. As a result, price reversed on them. They still held because they said, okay, it's a correction, it's a pullback. They held until 50k before they decided to sell. Fair enough, they made 2.5 times their money. But from 3 million to 50k, you feel more of a loser than I think if you lost your 20k in the start. Do not hodl. Do not. Such a bad idea. Instead, dollar cost average. So dollar cost average is when you allocate a certain portion of your portfolio to a coin. So say you have a £10,000 portfolio, you now want to allocate £5,000 to one coin. Dollar cost average would be you selecting 3 to 4 key zones and then saying, when my coin, will say Bitcoin, for example, when Bitcoin reaches 20,000, I will invest a quarter of my 5,000. If it hits 17,000, I will invest another quarter of my 5,000. If it hits 15,000, I will invest another quarter of my 5,000. If it hits 10,000, I will invest the last quarter of my 5,000. That would be dollar cost averaging, because as price goes lower, you continue to invest, which brings your average cost down from starting at 20,000 to being probably around, I'm not saying the best here, but about between 15 to 16,500, somewhere between that region. That is the benefit of dollar cost averaging. And if you invest more when price goes lower, your average price for that coin will be weighted down, will be weighted lower. So if you invested 1,000 when Bitcoin is at, if you invest $1,000 when Bitcoin is at 20,000 USD, but then instead you invest 5,000 when Bitcoin goes down to 15,000 US dollars, your average will be brought closer to 15,000 than it will be to 20,000, which is in your benefit, because then again you can make your money back faster and you can go into profit faster. Number 9, set realistic expectations. This is very important. Again, this goes back to the hodl point. You need to find your take profit levels and set them at key levels which the market has already achieved before. Once price hits your take profit levels, you sell. You do not then change your strategy because of something you've seen online and then move your take profit level higher. You will lose if you try to do this over a set period of time. You will lose. You set your take profit, you set your realistic expectations prior to you entering a trade, and you stick to them. Once price hits your take profit level, you remove your position out of the market, or you slowly start to scale your position out of the market, depending on how you want to do it. But you must follow your rules. Set realistic expectations. Doesn't means that you don't say that I'm investing at $1 and I'm not selling till 10,000. That's stupid. If you make more than 12% in the market, you have outperformed. I think the stats like 90% of hedge funds do not make more than 12% a year. So if you make even 30% on your coin, you've outperformed some of the biggest financial businesses in the world. With some of the best analysts that go to the best universities and have the best training. Don't get greedy. A 50% return on your money is fantastic. Yes, I know crypto has the potential to give you a lot more. It is true. But just stay realistic, because your bank account is offering maybe like 2% on savings at the moment, probably like 4 to 5% because of how high interest rates are. But you'll remember you're outperforming it, and you're outperforming inflation. You're doing very well for yourself. You're even in the crypto market and you're making money. 95% of people lose. So set realistic expectations. Don't get too greedy, or you will lose. Number 10, set take profit levels and stop losses. This is an important one. So we briefly spoke about the profit levels. So that's when for you to exit a trade, you want to be exiting your trade when your price has hit a key level above your entry point. You would have predetermined this key level, and I'll go into how to find the key levels and whatnot in the next video. Once price hits your take profit level, based off your strategy, you either take out your entire portfolio, or if that's what you wanted to do. But what I would normally do is I would only take out my initial investment or half my initial investment at my first take profit level. This allows me to continuously have exposure in the market and not take everything off the table, because that's not how I like to perform. I like to make sure I leave a bit of skin in the game in case price goes higher, I win. But if once price hit my first take profit level, I remove either half my initial investment or all my initial investment, which therefore leaves me risk-free in the market. So in case price was to tank lower, well, I'm not affected because I've already taken out my initial investment. Yes, my profits might lose, but my profits aren't my money. It's the house's money. It's the market's money. So I'm not losing. With regards to stop losses, we are not leverage trading. So we don't have stop losses. We don't. We use dollar cost averaging instead at very low levels to protect our capital, which is the reason why we have such a high strike rate. I believe last year our strike rate was 67 or 70%, something like that. I need to double check the numbers. It's so high because we take very few trades in a year, and two, we dollar cost average, which allows us to have such a low average buy point, and it puts the odds in our favor tremendously to make a lot of money in these markets. So we don't have stop losses. Number 11, less is more, and avoid diversification. Crypto market is not the stock market where you want to have a portfolio adjusted for several different sectors and several different companies. No. Crypto is a lot more risky than stocks, which is why you can afford to diversify like that in stocks, because there is a much lower chance of stocks depleting 90% over the course of a year than it is in crypto. Crypto, you hear so many projects which can lose up to 90% of their value even in a week, which is very rare in stocks. But for that reason, crypto also is the only asset class that you'll see 90% gains or 100% gains within a week. Stocks never do that. Very rare, very, very, very rarely, maybe on a micro cap or a nano cap stock, might you see that kind of behavior. But for crypto, it's more commonplace to see things like that. Stocks, yes, it's very unlikely you're going to see that on a stock. So in crypto, your better option is, since more coins are more volatile, you want to diversify less. You want to stay in more secure stocks, not stocks. You want to stay in more secure cryptos for the majority of your portfolio, and then with a smaller proportion, maybe say a third, a quarter, 40%, you then want to look into more higher risk plays and higher risk coins to therefore give yourself some exposure into the riskier part of crypto. You don't want to diversify and have 10 coins which all you put $100 into each coin. They could either 100x or they'll go to zero. More than likely for those small coins, which are meme coins, you'll find that majority of them, 99.9% of them, go to zero instead of 100xing. Very, 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 very few of them 100x. I must get that into you. You're better off. You are much, much, much better off investing into one or two solid crypto projects with a 200% return than 10 meme coins with less than 1% chance of 100x and more chance of going to zero. You're more likely to make your money and become a successful crypto investor with one or two solid projects with higher market caps and have had a longer history of sustainable price action. That is what you're looking for. And number 12, when to pull out your position. Very, very rarely have I had to invest in a crypto coin where I've had to pull out of my position. But again, in case of the scenario where that happens, which is very, very unlikely for this strategy, what do we do when we need to pull out of a position? Well, in the event of serious news with regards to the altcoin that we are invested in, like a CEO leaving, a large disagreement on strategy between the higher ups in whatever coin you're looking at. And when I say a disagreement, disagreements are normal. But if it comes out that it was a very nasty disagreement, got a bit messy, then I'm out. Or, for example, a better example I could use for those of you who are a bit older, you will know BlackBerry. You might have heard of it back in the late 2000s. In the scenario where you have a board of directors who are very stubborn and are very against change and adaptation, you now want to start moving away from a company like that. Because in BlackBerry's case, they believe that their touchpad was king. They believe that when Apple came with the touchscreen, that it wouldn't challenge their touchpad because they were doing so well. They refused to change. And then, well, look at BlackBerry now. Who owns one? That would be the scenario where I'm looking at, okay, I might want to pull out my investment, because we don't want to be investing in companies that aren't happy to adapt, aren't happy to stay with the times. If you notice, Instagram, once TikTok brought out, TikTok Reels, TikTok Shorts, then Instagram hopped on Reels, YouTube hopped on Shorts, Snapchat hopped on Reels. Pretty sure Facebook has it as well. Everybody hopped on. That is the adaptability that you want to see in your coin. You want to see that your coin stays with the trend. They keep up, because if they don't, they'll be outdated and they'll be left behind. So I'd only be looking to pull out of my position when there is a serious fundamental issue with my coin. It wouldn't be for drawdown. Drawdown is normal as an investor. I don't really see drawdown as a problem, especially when the fundamentals of a coin are good. Taking drawdown is fine. Doesn't matter. I'm happy to take drawdown because I know that we are always buying from a very discounted price relative to the rest of the market, that is. So we don't pull out of our position because we see drawdown. If anything, I dollar cost average even heavier into my position because I understand that I have a fundamentally good coin. So why would I not want to buy more at a cheaper price? That's the logic you want to be using. And yeah, that regard goes into everything with regards to the 12 points. Now we've got number 13, which is a little bonus. We do not buy Bitcoin. We buy altcoins. Not to say that Bitcoin is a bad investment. If you want to make an investment into it, I don't like Bitcoin because I can get a better return on my money from altcoins. Altcoins, remember, is everything that's not Bitcoin. So Ethereum, Litecoin, XRP, Algo. There's just so many out there. XLM, all these other coins. There's just so many. Solana, all these other ones. We use Bitcoin for the analysis because it is important to do the analysis on Bitcoin. Why? Because Bitcoin causes the rest of the market to move. You need to do your analysis on Bitcoin to understand whether it is a good time for you to buy or sell your altcoins or stay out of the market. It is very important that you do your analysis on Bitcoin to make that judgment on the altcoins and what you should do. So that is the Heat Academy investment strategy. Part 1. There'll be a part 2 for the pros and cons, but I'm aware this video